Hey, it's Matt Decker with Leveraged Wealth Management. I hope that you're doing well today. I am going to be recording a quick video here going through, I would consider this a frequently asked question, one of the most frequently asked questions that I ever get, and that is how in the world do these loans work on indexed universal life insurance? So right out of the gate, there's a couple distinctions that we need to make. Number one, there's different types of loan provisions. So the one that just about is standard in every company, no matter which company we're talking about, and really it's pretty much standard in indexed life and in whole life, is going to be a fixed loan, also known as a wash loan. And it's really simple. In a fixed or a wash loan, basically, you're going to get charged, let's say anywhere between 2 to 5%, but then they're going to credit you back whatever they charge you. So if they credit you, or if they charge you 2, they're going to credit you 2. If they charge you 5, they're going to credit you 5. And what it means is basically it washes itself out and you're not actually paying interest because what they're charging you, they're also crediting you. The other major type of loan on these policies, and the one that really everybody's asking about when they ask, how do loans work on these policies, is something called a participating loan. Participating loan. Now, a participating loan is going to have an interest rate anywhere between, let's say, 3.5% all the way up to 8%. And what this means is they're going to charge you somewhere between 3 and 8. Each contract is different, but they are going to let you retain the interest earning power of your money. So you're going to still earn interest on your money even when you take a loan. So in the case of a wash loan, charge you to credit you to. In the case of a participating loan, they might charge you 5%, but your credit is going to be however the policy performs. So you don't actually know what your credit's going to be. The upside, though, is that your credit could be 6, 7, 8, all the way up to, it could be a 15% credit. So in the case where you get a 15% credit and they charge you 5, you actually made 10% on your money. So this participating loan, this is the one that everybody has trouble with. This is the one that everybody wants to know, hey, how in the world does this participating loan work? And so I am going to show you exactly that. Before we get into exactly how it works, though, I should probably point out, I don't want to scare all of you off because I mentioned it could be anywhere from 3.5% to 8%. The only policy loan I know that's 8% is Northwestern Mutual, and so I would steer clear of them. Everybody else is quite a bit lower. Sorry, Northwestern Mutual. Okay, so how does this participating loan work? Well, first, you have to understand that there are 3 accounts involved in this participating loan mechanics, you could call it. So we have 3 accounts here. I'll label them in a second. So this first account is going to be, let's just call it your bank account, your SunTrust, your Wells Fargo. It's your bank account, your checking account. The second account is going to be the policy itself. So we'll call it the policy account. And then the third one involved is going to actually be the life insurance company account. Life insurance company account. Okay, so these are the 3 accounts that are involved. And here is where most people get confused. They think, I'm going to loan money out of my policy, and therefore, when I loan money out of my policy, money is going to actually leave my life insurance policy and it's going to be deposited into my bank account. And that is not how these participating loans work. And that's the source of a lot of confusion, because if that's how you think it works from your policy to you, then understanding the interest earning potential is really, really difficult. So let me explain to you how this actually works, and let's put some numbers behind it. Let's say that your policy account has $1 million in it. $1 million. Sounds good, right? $1 million in your life insurance policy account. And you want a $500,000 loan. Okay, so you want to take a $500,000 loan. Here's how it's actually going to work. $500,000 is going to leave the life insurance company account, and it's going to go directly into your bank account. $500,000 is going to leave the insurance company's account and it's going to go into your bank account. You'll notice your $1 million here, it's still intact. It hasn't been touched. Nothing has left your life insurance policy account. Now, the life insurance company is not just going to give you this loan without making sure that they have some source of collateral. So where do you think they're going to get the collateral? You guessed it, from your life insurance policy account. So what they're going to do is they are going to place a lien against your life insurance policy death benefit / cash value. Now, since it's a lien, still no money's leaving your life insurance policy. It's simply a lien, and right now the lien balance is $500,000. And what that means is if you die or if you decide to cancel your policy, first, this lien needs to be paid back from your $1 million, and then you get whatever's left over. So far, so good. I think everybody understands that. Okay, so here's where the interest earning potential, and here's where these loans get really, really powerful. So let's just say that this participating loan rate is a 5% rate. So 5% rate on whatever you loan out from the life insurance company account. So this $500,000 here, it's going to have a 5% loan rate attached to it. And let's also assume that in this particular year, this year that you made this loan, let's say that the S&P is up 10%. The S&P is up 10%. What happens to your policy? Well, you still have $1 million in your policy. That $1 million is going to grow by 10% because the S&P is up 10%. So in this first year, you took a $500,000 loan. You got charged 5% for that $500,000 loan. You also made 10% on your full $1 million. So that loan actually didn't cost you anything. In fact, you made money on the money that you loaned yourself. All right, so that's how a participating loan works. But there's also the downside to a participating loan because let's say the S&P is negative 10%. Well, if it's negative 10%, this policy gets no performance credit. So in the years where your policy performance doesn't perform, where the S&P is negative and you get a 0%, this $1 million doesn't get any interest, yet the $500,000 still has your 5% loan charge. So what that means is your lien balance is going to grow by 5%. And that additional 5% interest is going to be rolled up inside the lien and offset by your policy cash account and death benefit. And what's really cool about this is over time, over the course of 15 to 30 years, we can really effectively measure how often you actually outpace your loan provision in any given year. And what we've come up with is basically based on conservative assumptions, over the average, you are going to be able to outpace a 5% loan rate really easily. In fact, the average that we see the loan rate outpaced is somewhere between 50 basis points and 1.5 basis points. You're going to be able to earn over and above your loan rate in the form of policy credits on your $1 million in this example. Your average spread between what you're being charged and what you're earning is going to be a positive 0.5% or 1.5%. It's going to fall somewhere in there. This results in you being able to make tons and tons of consecutive annual loans from the life insurance policy general account to your bank account. And that's how you can see huge lifetime supplemental tax-free retirement distributions to you in retirement from these index universal life insurance policies. Now, real quickly, let me flip this on its head because we've kind of gone through, the rosy picture of using this, and we're talking about, an indexed universal life insurance contract where we can kind of track performance and we have lower loan provisions. So what I used here was, pretty standard loan provisions and, pretty standard policy crediting and all that. But I already mentioned to you that one of those policies that has that really high loan rate, the 8% loan rate, 8% participating loan rate, is Northwestern Mutual. And so let's assume for a second, and this is why whole life insurance does supplemental retirement income really poorly. Let's assume that you try to take that same $500,000 loan from a Northwestern Mutual policy, and they're going to charge you 8% interest on this $500,000. Your cash value in this Northwestern Mutual policy at most is going to grow at maybe 4.5%. And you've essentially locked in a negative 3 to 4% arbitrage every single year between what they're charging you for the loan and what you're actually earning on the policy. And that's why, in my opinion, and just from a math standpoint, if you're looking at cash value life insurance for supplemental retirement income that you can access tax-free that has no market risk, it is extremely difficult to do that in whole life where you have unfavorable loan provisions and something like a 4 to 5% rate of return. You're never going to be able to make up the spread between those two. And that's why Index Universal Life works so well. We have lower loan provisions. We can access our money at 5%, sometimes less than that. And our policy credits are higher. Our average credit is somewhere between 6 to 7.5%. And so on average, we're able to get the spread between our credit and our loan provision. And that's how loans work. And that's why people use Indexed Universal Life Insurance for supplemental retirement income that they can access tax-free. So I hope that this was helpful. The key thing here when talking about loan provisions and how they work is just to simply understand that there are 3 accounts involved in the process. There's your bank account, there's the policy account, the life insurance company account. When you take a participating loan, money leaves the life insurance general portfolio. It goes directly to your bank account, and at the exact same time, the company files a lien against your life insurance policy for the loan balance, and that's how you retain the interest earning power of your dollars. This has been Matt Decker with Leverage Wealth Management. If you haven't done so already, subscribe to my channel. You can do that below. Click the bell to make sure you get notifications when I upload new videos. And as always, let me know what topics you want me to tackle next. If you need an Index Universal Life Insurance policy review, you can get one by going to my website, leveragewm.com/IUL-review. Thanks so much. Talk to you next time.